Good morning, everybody. How are we doing? Hey, look, I've got a timer, everyone. We're going to try and keep this to an hour today. Going to try. We should be able to today, actually, because today's going to be about hedging and it's going to be about theory rather than actual doing. So there we go. Morning, FTNet, Jules. Good evening, Bill, Vitali. Where can I get the music from your intro? I don't know. It's stock music from Envato. Camtasia projects. I don't know what it's called. It's called Epic Cinematic Heroic Trailer. Epic Cinematic Heroic Trailer in music. There you go. Here it is. That's not it, is it? No, that's a different one. I honestly don't know. You're the first person to ask that question. I don't have an immediate answer. I will find it. Yeah, I'll try and find it and see if I can remember what it is. It'll be in one of the video. I use Camtasia for video production, so it'll be in one of them somewhere. I don't know where though. I'll find it. Morning, Baggy. Right, so today, I've waffled on. Look, we're always 2 minutes in. So today we're going to look at hedging and hedging strategies. So I was planning today to do some testing with an EA to show how hedging works and the various hedging models. But the reality of actually building a hedging EA is actually quite complex because there are an awful lot of what ifs scenarios in hedging. And there's multiple ways to do it as well. Morning, noob. So what I haven't managed to get there, what I've managed to do is build an EA partly to do one version of hedging, which I've got kind of working. But this doesn't work properly. So what you find with hedging strategies is when they don't work, things like this happen. You get an offset which isn't quite in the right place, depending on how you're doing your hedging. And you get instances where something will happen in the market which just doesn't close one out because of some reason. It hits a TP, but it doesn't hit the other TP or something. And you have to kind of go through a process of make a change, test it all out, find the problem, make a change, test it all out. And it's quite a long-winded process to get it actually working with the model properly. And there's a number of ways to do it. So I've got something that kind of works from a hedging perspective and produces a nice little equity curve until it doesn't. It gets stuck like there. We've got a buy on, but we've got no sell hedge in place. So there's rules I've got to put in place to constantly do this. So it's going to take me a little bit more time, but I will do that. And I aim to get that ready for Friday. And then on Friday, what we'll do is we'll look at some of these models and we'll test some of these hedging models to show either why they don't work or why they work well, but the pitfalls. So that's really what today is about, is to looking at different hedging models and ways that you can implement them, because there's a lot of different ways to do it. So start off with, let's just get a blank chart up. We need to look at what hedging is. So there's a common misconception with hedging in that it's what the hedge funds do. Yeah, the hedge funds do not hedge. Okay, and in the sort of the way that you would think of a hedge. Yeah. So there's three different types of hedging. You've got single currency hedging, which is where you trade one instrument, or single instrument hedging, depending on what you're trading, where you trade one instrument. And basically on that instrument, you take a direction. And then if that trade works, happy days. If that trade doesn't work, instead of taking a loss, as you would traditionally do with a stop loss based strategy, you take a trade in the opposite direction. Yeah. Which basically locks a profit in. Yeah. A loss rather. So that the distance between the long position and the short position is locked in as loss. So the idea would be then that you wait to see what the market does, and wherever the market goes, you would then exit in that direction with a profit, and then you still have a big long position left. So you then need to either scale into a long to dollar cost average and then re-hedge, or you just wait for that to pull back the distance of the hedge and get out of that at a break even, meaning that you lock in that profit. Yeah, so that's one model of hedging. And this is kind of the single currency hedge, which is what people tend to think of mostly as hedging. Yeah, so you're taking a long and a short, and the short is basically your stop loss, if you like. Now, there's many variations of it. You can use lot multiplication. You can use martingale. You can use all sorts of things to increase the probability, but also at the same time increase or decrease the risk of the trade as well. So there's a lot of different things you can do and you can adjust. So when you're looking at system parameter permutation testing with hedging strategies, they're even more complex than normal. Yeah. So that's a kind of a single currency hedge. So we're looking at one currency or one instrument like oil, gold, or whatever, and we are basically taking trades in both directions at the same time. There is no stop loss involved. Yeah. Our aim is to wait for the market to prove one direction enough that we have a positive monetary outcome. Then we close the position and go, I didn't lose anything. So you could close in a break even, or you could close in a small profit, or you could hold it if you're directionally biased one way longer than the other or bigger than the other, and go for a big run. Yeah, there's a million outcomes of it as well. So that's single. The other type of hedging is multi-currency hedging, or MCH. So we've got single currency hedging, we've got multi-currency hedging, and then we've got what I class as institutional hedging. Yeah. So multi-currency hedging is where you trade two assets or instruments on that contain the same currency but in a different direction. So best way to explain this is probably to get two charts up next to each other. So we'll get Euro CAD and Euro US dollar. Okay, let's put them side by side. So I've got two instruments here, Euro CAD and Euro US dollar. Both of them are a Euro cross. Okay, so with multi-currency hedging, what you're going to be doing, or multi-instrument hedging, is you would go long on one of them and short on the other one. Yeah. So if there is news on the euro today, the euro is going to go big move long or big move short. We don't know which. So if you go long on one and short on the other, when that news hits, you will find that there is either going to be produced a positive or a negative differential in the amount of money you are in profit on one and in drawdown on the other, because you went short. Yeah. So sometimes that will come out as a positive and you basically just close both of those out and go, thank you very much. Sometimes it comes out as a negative, which means you need to hold it and wait and see if it comes back positive. And if it doesn't come back positive after that news event has occurred, you would then readjust your hedge, which involves lots of complex calculations with lot size, distances, all sorts of things. And it's an incredibly complex way of hedging, but can be very effective. The advantage you have with multi-currency hedging that you don't have with single currency hedging is that you have, in this case, the Euro CAD, and this case, the Euro US dollar. You have movement on the euro, which is going to be usually the same in both instruments, but you have the opposite happening with these currencies. So you could have the Canadian dollar drop and the US dollar rally, which will create a different profit or loss value on your euro portion of the trade because they're crosses. Yeah, so we're crossing two currencies together. So you've actually got three currencies involved in your hedge, not two, which gives you more movement up and down. Pros, it can play out profitably very, very quick. If you get a strong move on the euro and a strong move on the US dollar at the same time, for example, like tomorrow we got a news event with both of them on the same day, it will just make money. If they go the opposite direction, though, it will go into bigger drawdown than anticipated, which means you've then got to manage that hedge, and that's where the complexities come in. So that's the second variation. Again, there's massive pros and massive cons with both of them. Yeah, so I've got a multi-currency hedging EA set up already, and I've gone down the route of trying to trade this, and it's a very hard thing to test because MT4 has restrictions, obviously, that it can only trade one currency. MT5, you can trade multiple currency, but this is something you need a hell of a lot of discretion in. So, and you need to be aware of news events. There's too much outside intervention, if you like, to make it something you can easily backtest. And obviously, if you can't easily backtest it, you need to spend a lot of time forward testing it, which involves an awful lot of time and effort. And to be honest, I didn't actually find a massive different edge over normal hedging on a single currency anyway. So that's the second type of hedging. Third type of hedging is what hedge funds do. Yeah. This isn't something that we can do because we're not a hedge fund, right? But everybody jumps on the bandwagon because of hedge funds. Yeah. So the hedge funds make a load of money. Yeah. So everyone goes, well, the hedge funds are making a load of money. I'm going to do what the hedge funds do because they make a load of money. But what hedge funds actually do, or hedge the actual fund of a hedge firm or department in a bank, whichever one, whatever type of organization it is that's performing the hedge, is they are offsetting one risk against another risk. So a typical and the easiest to explain hedge is corn. Yeah. So a farmer will basically produce a batch of corn every year. Yeah. He will then look at the futures market, which will say what the price of corn will be in the future. And assuming his crop works nicely, yeah, and it grows and he can sell it, that is the anticipated price that he will receive for his corn when his crop is at its maturity and ready to be harvested. Yeah. However, Ukraine gets invaded by Russia, and that farmer now doesn't have a field left because it had a missile in the middle of it and it caught fire. So he is now bankrupt. So what will happen to the price of corn, because the field has disappeared, is there's less supply of corn. Therefore, the price of corn will rise higher than anticipated in the future. So he will employ a hedge fund to take the opposite direction, which basically builds in a buffer of profit. Yeah. So a hedge is basically a backup plan if things don't go well with what you anticipate the future price of something to be. Yeah. So when we look at things like the COT report, I'm just wondering if this will, yeah, there we go. Just going to see if I can quickly see. Yeah. So within the COT report, which is the Commitment of Traders report, which is the report of all futures positions, you have two main parties in there. You have commercial orders and non-commercial. Oh, you go there. Commercial traders and non-commercial traders. Commercial traders are the hedgers. Yeah. So when you see the COT report, which gives you a bias of which way the trades are going, within that COT report, you have commercial traders. Commercial traders typically are the hedgers. So if a hedge firm has a short position on the US dollar, It does not mean they are expecting the US dollar to go down. It means they're expecting the US dollar to go up because they have another trade on or another investment on, which if the US dollar rises makes them money. But if the US dollar drops, they will take a short position, known as the hedge, on the US dollar as well at the same time. So hedge funds make money regardless of which way the market goes. If the market goes in the way of the corn seller, they take a commission on that. And the difference between what they take the commission on and the sell price and the actual hedge and what the value of that hedge is always going to be a profit. And they go the other way as well. So if you're expecting the price, a really bad winter or a really bad summer, for example, weather-wise, or a flood, you're expecting your corn value to drop, you would hedge long on corn. So you would employ a firm to hedge the opposite direction. Same happens with Japanese exports. Japan exports vast majority of its goods to the US dollar, to the US. So what it does is when it buys parts in to manufacture electronics, puts them on a boat and then sends that boat to the US, that process will take 6 months, possibly. Yeah, so it takes a long time to happen. What they will do is when they buy all those parts, they will look at what the US dollar is now and expected to be in the future, and they will hedge the yen against the US dollar, meaning that if the price of the US dollar goes up, their hedge will increase in value. If it goes down, their hedge will decrease in value, but they keep a buffer zone where they're constantly going to make a profit. So that's what hedge funds do. Long and short, really top level view of what hedging is in institutions. It's a hell of a lot more complex than that. You don't need to know about it because we're not interested. Yeah. But I just wanted to differentiate what a hedge fund is. And this is why people get interested in hedging. They're like, hey, I'm going to do what the hedge funds do. No, you're not, because you can't. Hedging within retail trading is multi-directional positioning to lock in profit or loss. Yeah, and that's the thing that we can do as retail traders. So we need to look at different ways of hedging. So there's two main strategies that you can use in hedging. The first one is to have a trade idea. So let's come up with a trade idea on the Euro US. Yeah, so we've got a propulsion gap here. So what we're going to do is, as we're in this propulsion gap, we're going to take a long order here. And we're going to assume that the participants here are going to bounce price and it's going to go up to our take profit. Yeah, so that is our trade idea. If our trade idea fails, rather than taking a loss on our account, we will take an opposite position and we will lock in that loss. We will freeze the loss. Yeah, so we cannot make more money or lose money, and that is made by taking the same size of position long as you take short. Yeah, so when you go long 0.1 and you go short 0.1, you will have a loss in your P&L of whatever it is. And that loss is locked in. Doesn't matter if price goes down, doesn't matter if price goes up, your P&L will not move. Think stock index hedge strategy. I haven't got a hedge on today, but you've seen hedges in here. You see that sits at negative $350 or something, and it doesn't matter if price goes parabolic to ADR, that never changes. Yeah, I've gone the same amount of lots long as I've gone short, so that is my loss, and it ain't going anywhere. So that's how you create a hedge, a traditional hedge. So once we've got this trade on, it either hits the target and we don't need to worry about that trade and we can just remove it and happy days, our trade worked out, or we've now got a problem. We've got a short order and a long order and a loss in our P&L. So the traditional way of getting out of a hedge is to wait for price to move to another area and then exit the short position when you are expecting price to come back in the other direction. Yeah. So if I'd got long here and short here, i.e. the propulsion gap failed to hold price, I would expect it to come down and test this level. And what I would do is when we get down here, I would close out my short position and bank that money. whatever that money is. It doesn't matter. Yeah. And then I will go, okay, hopefully now price will bounce off of this level. And if it comes back far enough that this long position, the drawdown on it is lower than the profit I've made, I can then close out my long position at either a break even or a profit. Because if I've got, for example, when prices come down here, I make $800 and it bounces back up to here and my drawdown is now $700, I can close that $700 drawdown, remove it from my 800 and I bank $100. Yeah, great. However, that relies on you knowing when price is going to turn around. It relies on price turning around, and it also relies on price moving far enough back in your buy's direction that this drawdown gets lower than that. Yeah. So that is a traditional hedge strategy. So what you're doing, instead of going long and taking a loss of X% on your account, you are locking in the drawdown and giving yourself a second opportunity to trade. So you're giving yourself a backup. The problem occurs now is if that bounces and it doesn't work out and then it slams through that level, you need to re-hedge. Yeah. So if you're 0.1 long there and you've gone down to here, you've taken the profit off this one, it's bounced up and it's popped down again, you're going to need to put a 0.1 on down here so that that is now locked in. But now the problem is your loss is that big. It was that big. So whatever that hedge was, $500, $800, whatever, it's now $1,000. But you can't lose any more because it doesn't matter if price goes all the way out there. It doesn't matter if price screams down there. You've locked that amount of money in. You're hedged. It's not going to change. So that is the downfall of that type of hedging. It's very effective from a support resistance basis. We were talking, Linus, this morning about the blue Porsche guy. Yeah, that's what he does. Now, if you've joined his group or done his course, you will know that he talks an awful lot about the ones that work, but the ones that don't work suddenly disappear and they go quiet. Because when you do this type of hedging and the market goes parabolic like this, what happens is if you took a short position here and you locked in a hedge here and you got out of that hedge there with your profit and then it pushed down and you re-hedged there, your hedge is now that big. And you go up and you find another resistance, you get out of that one, you make some profit, and now your hedge is locked in and it's that big. And rinse and repeat. So what you actually end up with, instead of this little hedge down here that you had in this distance, you end up with a hedge that's that big. Because you got it wrong on all the previous hedges, all the preceding hedges that came after it. The ones that came after. Yeah. So now you've got a long here and a short here and a massive drawdown. So you've got to get rid of that drawdown. So there is a way to do that, and it's called working the inside of the hedge. So what you do is you wait for price to come down in the middle somewhere, and then you take another hedge in the middle. And you basically say, right, what I'm going to do is I'm going to come down. I think we're going to bounce here, and I'm going to go long. So I'm adding twice the lot size long than I've got short. If that pushes up to around about there, I will be able to close that position and close that position and then use some of that profit to reduce this. But now my hedge has reduced a little bit. So I've got less size in hedge and I've been banking, which is great. So my P&L is going up, but I've got still locked in drawdown I've got to deal with. And you rinse and repeat that process, which is called working the edges of the hedge constantly and reducing bits of hedge down until the thing's disappeared. There's a strategy out there taught on YouTube that teaches this, and it is a very good method, but you are involved in this manually because there's no way of programming anything to identify where you think, because it doesn't know, price will likely bounce from to give you enough to give you some profit to work the hedge, drop it down, blah, 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 blah. And it goes on and on and on. I built a model to do this. The problem with this style of hedging, which is working the inside, which is always the answer to everybody that does this style of hedging, is always like, yeah, I'll just work it from the inside until it's gone. It takes months. If this market then decides your hedge is there, for example, decides to do that for 2 months, think euro pound we've been through for the last couple of months, yeah, you won't get out. Because what it'll do is you'll just add more hedges in here and you'll lock in more loss and you'll just be stuck. It needs to move. The problem is the market stays in range bound activity for 80% of its life. Hedging and hedge recovery in that way relies on strong market movement in one direction, which happens 20 to 30% of the time. So it does work, but the problem is if you get into one of these big locked in hedges, you are stuck and you will be stuck for a long period of time. I built an EA to model this and it had an equity curve which was positive over a period of many years. But there were stagnation periods in there going on for 3 to 6 months every year where it just did not generate revenue. And then it would suddenly go to a period. So the P&L on it would look like this. It would be like, hedges are working, hedges are stuck. Hedges are working, hedges are stuck. Yeah. So you get a bit of money here and a bit of money here, and then you sit there in doom land for months on end. It's not particularly good strategy. Theory and practice, you will eventually get out, but it doesn't work very well. Yeah. So I wanted to cover that because obviously there's going to be people potentially that have looked at that type of exit strategy for hedging. If you have looked at hedging, so that's the pitfalls of it. Happy to build that model again. I might even have it. But that's a very difficult one to work. Another good hedge strategy. I made another coffee because I've got a sore throat at the moment. Another good hedge strategy is the one that we used to trade with the market reverse alert CA, which is the H1 hedging strategy, which basically is where you get in and on an RSI extension. Actually, let's look at a chart with an RSI on it, make more sense. Yeah, so you get in on an RSI extension, short, for example, and you also get in on an RSI extension long. Yeah, so you just wait for one of those trades to work out. The other version of the trade, you basically turn into a position trade. Yeah, so it's exactly the same as position trading, except it trades in both directions. The advantage of this type of hedging strategy is you are always going to be winning. Yeah, so if you use both ends of the RSI and allow the EA or your strategy to trade in both directions, it doesn't have to be RSI, it could be any reason you get in long and short. But if you get in long and short, it doesn't matter which way the market goes, does it? You are always going to bank money. So if the market sits there and does that, and you get in short and you get in long, as long as it does that, you're going to continuously make money. When it breaks, that one is going to make more money. And that one is going to go into drawdown. So you turn that into a position trade and go back the other way. If it pushes back but doesn't get you to profit, you get another short on. And if it goes down against you, you make more money on the shorts, but then you're going to have another long on. So it's a variation on position trading. You can do this and test this. There's a set file already for the market reversal alert CA. In fact, I've probably got it. Let's just quickly test this one because we've got that. Yeah, so let me do this on control points on hourly. So let's see how quick the market reversal alert CA is very slow. So we'll see how quickly we can get this working. Right, so we've got reverse alert, so we've gone short. Yeah. So it doesn't use RSI extension, this particular strategy. It just uses reverse alerts. Yeah. So we got out of that one, but we've also gone long down here. So we had a reversal alert there, so we went long. That didn't work out, pushed down, so we're adding another long on. Yeah, but we made money on our short position, so we're up. We're just sitting now in drawdown. this has got drawdown control in place as well. So we took a little bit of drawdown control, but because we've made the money there, the drawdown control that we did there is lower than the profit. Therefore, we're just using some of that to offset against that, waiting for the market to go back up. We exit those positions, happy days. So we made money short, we made money long. Yeah. So this style of hedging strategy is basically getting in. It's kind of an always in every signal type strategy, and you can use any indicator you like for it. You could use a moving average cross, you could use market reverse alert, say in this EA, in this case, market reverse alerts indicator. You can use a Bollinger Band extension, you can use an RSI, you can use an oscillator, any oscillator, you can use anything you like. But the premise is you get profit always. So your P&L is constantly going up, because it doesn't matter what the market does, one of the trades is going to make you money. You then deal with the other trade by position trading out of it, or DCA out of it. And most people that use this style of strategy for hedging will use the long position, in this case, because we made money on the short, to just get break even. So they will not try and make profit on the one that fails. They will just try to get out of it with a break even, or a loss on that long trade, which is smaller than the short. Yeah. So if you've made $1,000 here and you can make $600 loss on the long trade, you've made $400. Yeah. So it doesn't have to, and again, this is all kind of discretionary, because there's a million ways you can do this. You can decide, I just want to be out of the one that's wrong, and I'm just going to let the winners take care of themselves, which is the whole idea of this type of hedging strategy. Yeah. And it works really, really, really well until you get a squeeze, and it doesn't. Yeah. So look, reversal alert short, happy days. Reversal alert long, happy days. Reversal alert long, happy days. There wasn't a short there because we were already out of the short. We didn't have another signal to go short, so it obviously didn't take one. But you just keep trading, and the idea is you just take everything. Yeah, doesn't matter. It's either going to work or it's not. The reversal alert indicator has a very high strike rate in range bound and mean reversion scenarios. In parabolic trends, it's no good. It will play out eventually, obviously, because that's the whole position trading methodology, is the fact you can't go that way forever, can you? So, but what it does from a P&L perspective, let me just get rid of this and move it over. What it does from a P&L perspective is it creates a lovely steady equity curve. So these are the positions that went into drawdown, but all the time the market is fairly range bound. All you're doing is you're consistently banking cash, and it's really, really good. Yeah. But you will have periods where you go into squeezes, and it will, depending if you're using drawdown control or not, but it will go into losses. The problem with it is, because you are constantly long and constantly short, you are always in drawdown. And when we ran a test on this last year live in the live rooms for 9 months. It did 100, I think it was 130, 150% return. Fantastic. But it was always in somewhere between 20 to 50% drawdown on account, because it was constantly banking all the time and always in drawdown. Yeah, because you cannot be right and wrong. You have to be long and short, which means you are always going to be wrong, but you're always going to be right. Yeah. So it's a higher risk strategy. I don't actually know. This is a test file. I'm not sure if this is the actual one, but you can see the hedges take care of themselves. They generate constant profit, which you can use in the drawdown to offset. That's the whole point of hedging, isn't it? We're trying not to take a loss. We're trying to lock in the loss until the market proves it right. That's the whole idea of it. Otherwise, you can just take a stop loss. So that's another variation of hedging that you can do. The third variation, and the one that Alexander came up with in the members area, is the martingale variation. Yeah. So with the theory of martingale, what you are doing is you are constantly putting the market in your favor. Okay. So there's two variations on this. And this is the one that I'm building out at the moment. Yeah. So if you can find an area that has a high probability of a breakout happening, and this is the key, this is a breakout strategy. Yeah. And this is probably, I think, the best type of strategy for hedging, the least complex one. If you can find a high probability breakout strategy, they can work incredibly well with hedges. So let's say, for example, we've got this strong push. So the market has been pushing and pushing and pushing. You could use RSI extensions for this. So when you get an RSI extension above 70 or 80, you say, okay, what I'm going to do is I'm going to wait for the market to slow down and accumulate a little bit. And then I'm going to place a hedge position on that accumulation. So an opening range breakout, for example, on stock index hedge, we are basically waiting for the market to decide which way it wants to go. Momentum breakout long, momentum breakout short. If the momentum breakout happens to the short side and it works, you set a TP around about the same distance as the hedge and you basically get out. Job done. So I'm not in a hedge. Fantastic. If the TP that you set doesn't work out, and what happens is it breaks short and then it pushes the other way and enters you into a hedge, what you have is a stalemate situation where you've gone like 0.1 short, 0.1 long, and you're stuck. So the only way we can get out of this one is the first scenario we looked at, by trying to guess where price is going to turn and hope we get it right. But the other way of doing it is, instead of going with a 0.1 long, you take a 0.2 long. So that didn't work out. But now what we've got is double the lot size long than we had short. If this breakout works and hits our TP, we can close that completely and we haven't lost any money. Yeah. So you're going to get out of the position with a break even, basically, because it's going 0.2 long. So you've got double that. You've got a 0.2 profit there and a 0.1 times 2, which is a 0.2 there. So you can close the whole thing out there as a break-even trade. So the advantage and the edge in this type of strategy is, if the break works to TP, you make profit. If the break fails and hits that TP, you get a break even. So you just sit there and you hope that the breakout works. When it does, you make money. If it doesn't, you don't lose money. So you're removing the loss from your portfolio. So your P&L looks like this: win, nothing, win, nothing, nothing, win, nothing. And it can't go down because all we're doing is either winning or we're not losing. That's what the P&L looks like. The problem, as you probably know, with martingale is, if you take a trade short and then you go long with a 0.2, and then you go short with a 0.4, and then you go long with a 0.8, and short with a 1.6, and long with a 3.2, eventually you either cannot get the leverage on the next lot size on, because your broker goes, you're having a laugh, I'm not taking 164 lots long, you've only got £1,000 in your account. So you can't physically complete the hedge, in which case you're stuck and you just sit there and go, I'm dead, can't do anything. Or it goes to the point where it does get that trade on and then it draws back down, and that creates a negative equity on your account, which you then get stopped out on a margin call. Yeah. Market spends 80% of its time sitting around, 20% of its time in price discovery. Remember what we talked about, how the market moves, why the market moves? The market is constantly seeking what? Balance, so that I can get these bloody orders off my desk and get my business done. No one's willing to trade down here anymore. Let's see if there's a price discovery area up here I can go and use. That is less regular than that. This strategy is playing on the idea that one of these is going to move far enough, double the hedge distance, so that we can exit that hedge. So it does have an edge, but it has to be done in a careful way, that you've got to be able to time these entries so that you know there's some volatility coming. When do we know there's volatility coming? News. Yeah. So this style of trading will work most of the time very well when you have fundamental news releases happening. So one of the ways you can implement this type of strategy or this type of hedge is around news events. Yeah. So for example, this morning we've had the pound CPI number. We all know what's happened during the pound CPI number. Yeah. So what we can do is with the pound at, I don't know, 1 o'clock this morning, whatever. Pound odd's probably not the best example. Euro pound is a better example. So this morning at 1 o'clock, we get our EA to go, okay, get me in with a hedge of 0.1 ADR, 0.2 ADR above where price is, and stick another one down there, yeah? And build me a position, which is also known as an accumulation, yeah? Accumulate me a position. And my positioning will either be, at this point, long bias or short bias, because my lot size is increasing exponentially every time we change direction. So I'm always going to be biased one way or the other. So I will either make money, if the last order placed is a long, I will make money if it breaks long. If the last order placed is a short, I will make money breaking short. You're always hedged with a positive bias in one direction or the other. When the news breaks, if I was short, it breaks, I enter my next long and I out. Job done. If I was long, I'm out. I'm long. Yeah. So you will always be able to get out as long as there is volatility at news. Occasionally on news events, we get whipsaws, which aren't going to help you because all you're doing is adding more, adding more, adding more, adding more, adding more, and not going anywhere. Yeah. So there is a danger in that respect. So there's certain news events where that type of strategy using martingale works very, very well. The other variation of this, which I think is a better way of doing it and a safer way of doing it, because you've got a lot less risk involved, and I hate martingale, although I have proved many times it's incredibly successful, or can be incredibly successful. Why have I got a buy on the euro pound long up there? Because, all right, I'm just going to shut that. I just suddenly noticed, don't want that. That's because this is an MA cross from an extension on 4-hour RSI. Although I got out of that one, that candle is actually opened below and closed above the moving average after a 4-hour RSI extension. So the EA's taken a second trade. I just need to check my other pound pairs. Sorry, one sec. That one's fine. Didn't do the pound CAD. That's good. Just checking that I'm not overexposing on that. I don't want to get in after the move. There we go. Pound US dollar ADR. So yeah, so the second variation of it is you take you basically wait for price to accumulate, or you don't. It doesn't matter, but you wait for price to ideally accumulate, and then you set a hedge offset outside of that range, and basically you go long with one order when the price breaks it. So you'd have a pending order there and a pending order there. You go long when price breaks that. If that trade works out, you have a TP, tick, happy days. Why are you taking additional trades? Sorry, bear with me one sec. Yeah, it's still extended on the 4-hour RSI. Let me just set this to short only. That will solve that problem. Do not want to get in all the way up there. So yeah, sorry. So basically the other way of doing it is you wait for the accumulation. You have a pending order long and a pending order short. If it breaks long and goes to your TP, happy days. If it breaks long and then it breaks short, what you do is you make this trade here. So if this is a 0.1 long, yeah, you make this trade here larger than that one. Yeah. So you take the first entry at a lot size. The second entry, if it is required, is at a larger lot size. Say, let's say 0.15. What that does is it puts the bias in your favor for short trades. If it breaks long, i.e. that does not work out, and it goes long again, you add another 0.15 up here. So what you now have is 0.25 long and 0.15 short. So your bias is now long. If that doesn't work out, you come down and you add another 0.15 short, meaning that you now have 0.3 short and 0.25 long, meaning you have a bias short of 0.3. Then, if it doesn't work out, you add another 0.15, which takes you up to a 0.4 long and a 0.3 short. So what you're doing is, by not martingaling and adding exactly the same lot size every time, is you're just giving yourself a bias in one direction. And you're waiting for the market to make its mind up. And when it does make its mind up, you will always have a positive bias. Yeah? But because you're not using martingale, you're not suddenly going to be trading 168 lots in 10 trades time. You're still going to be trading 0.15s. So your overall lot size and overall lot exposure, and more importantly, the size of monetary value of your hedge is not massive. Yeah, this is the preferred way of doing the constant breakout. So this range, whatever it is, however it's defined, it could be the opening range on a stock index, it could be an accumulation in Asia, the Asian range breakout or the London breakout strategy. It could be a 5-day accumulation where we've had an inside bar week and you're going to take a break of that week. Could be anything you like, but it's a range breakout, but using hedge, not loss. So the advantage of hedging, and this is why I have the opening range breakout EA and the stock index hedge EA, they both do the same thing. So they basically do this. If you use a stop loss and you're a breakout trader and the breakout fails, you lose money. If you take the short and it does that, you lose money. If you go long and it does that, you lose money. If it does that after you've gone long, short, you lose money. So in this particular instance, we've got 1, 2, 3, 4 losses, and now price is back in here. So we are 4% down on our account because the market is range bound. Hedging, we are locking in, I'm assuming there's a 1% risk on this trade. We are locking in a 1% loss. We are not adjusting that. We are just locking that in, and it will gradually get a little bit bigger as we add tiny locked increments onto the size of the hedge, but we're not going to suddenly lose 4%. If it spends the entire day doing this, at the end of the day, we haven't lost anything. What we're waiting for is the market to make its mind up. It will, because it's not going to go sideways forever, in the same way as it doesn't go up or down forever. So it's a much nicer, more comfortable way of hedging. The disadvantage of this, and there's always a disadvantage, is with the martingale strategy, when you enter long and your TP is there and it doesn't work out and you enter short, your TP can be in the same place. It's the distance of the hedge away. Whatever the hedge distance is, you place your TP the same distance away, you're guaranteed to break even. Worst case scenario, you're going to break even. If you move it slightly further away than the size of the hedge, you're actually going to make some more money, which is even better. Yeah, but it's going to be harder for the price to hit that level. So this is a 1R. If you made it 1.5R, you're going to make more money on the hedge that breaks, but it's going to make it harder for it to get there, isn't it? Yeah, so you might find you're in your hedges for longer. The longer you're in a martingale hedge, the more chance of that account exploding. So not great. The disadvantage of the other strategy, where we go long with a 0.1 and then we go short with a 0.15 or a 0.2 or whatever it is, and then we add the same lot size every time to give us a directional bias, is that distance from the hedge is not going to be a break even. It has to go a little bit further to get us a break even, because we've got a 0.5 bias short in this case, which means we've actually got to get to 1.5R to get our break even. But the advantage is we're not going to be exponentially increasing our lot size to the point where we blow our account. So this is what Alexander posted. Let me see if I can, for those of you that don't know what he posted. Let me see if I can get the graphic up. So this is the graphic that he posted. In this case, it's called a recovery gap, but it is literally martingale. Yeah. So you take your first trade long with 0.1, and then it doesn't work out. So you go short 0.2, 4, 8, 16, 32, 64, right? This, if it's a 5-minute chart, yeah, within 2 hours, I'm 1.28 lots short. I started with 0.01. Yeah. I'm over 100%, 127% of the original lot size I had so far in the next couple of hours. If that continues and this thing stays range bound, we had a day on the DAX a few months ago where it literally did that the entire day. And I said in the stream the next day, I have never witnessed that before. The DAX literally held a range of about a quarter of an ADR for the entire day. The algorithms were killing it. But if you were in martingale that day, you wouldn't even have lasted the day. You're dead. You're blown. Yeah? Because it just doesn't work long term. You'll find the equity curve goes like that. And you're like, this is it. This is it. Oh, what happened there? We had 12 trades in a row that went long, short, long, short, long, short, long, short. Oh, crap. Yeah? And that will happen. That will happen. Not often, but it will happen. And that is your account blown. So martingale works fantastic for short-term trading, doubling accounts. Yeah, you can use martingale to double an account. Why do you think none of the prop firms allow martingale? Well, most of them don't allow martingale. Because short-term, you can absolutely destroy it. You can treble, quadruple plus an account. The guy with the blue Porsche, Linus, he teaches you a strategy to do that. But he tells you you're going to blow your account using it. Thanks. The trouble with it is as well is from a psychological perspective, right? You start doing this and what you see is success. So you take a $1,000 account. Within 6 weeks, you made it $2,000. Your brain is now saying, that was easy. So I can make $1,000 a week. All right, well, I'm going to go with 5. And you do that and you go to 10 and you're like, love, I've just made $5,000 in a week. And then you go, oh, I'm going to take that 10 and I'm going to make it 20. Admittedly, you only lost 1,000. But if you've drawn any of this money out, well done. If you haven't drawn any of this money out, you've lost your 1,000. And also, you've wasted 2 months of your life following something that isn't working. If you go and back test it over a period of 4 years, you'll know it doesn't work. Yeah. So that is the strategy there. Now, there's absolutely no difference whether you use a hedging strategy here or a stop loss strategy. If you go long with 0.01 and it doesn't work out, use a stop loss and flip and reverse short with 0.2. Put your stop loss there. If it doesn't work, stop out, go long with 0.04. If it doesn't work, rinse, repeat. So the whole premise of this being a hedge trade is irrelevant. Make it a stop loss. It doesn't matter, does it? You're either going to blow your account by continuously losing money and your exponential losses are going to get bigger and bigger and bigger, and then you're going to have a whacking great win, which makes you that much money, or you're going to be in a hedge. And what's going to happen is your P&L won't move, but your drawdown line will go down there, and then your drawdown line will jump back up, and you'll go, pop, I made a little bit of money. Not good. Yeah. So those are the core strategies out there that I know of and I have looked into for hedging. Yeah. And I think maybe some of you probably know some of these. There you go. This is the reply I had to Alexander in the group. Yeah, this is the problem. A day like this, See my hedge here, the stock index hedge EA went long and it went short and it sat there and went, right, you make your mind up, market. So I sat through all of this with the stock index hedge EA. Then the market went long and I was like, right, you're going long. Where are you going? And I'll look for areas of resistance and price action that I can say, when we get there, if we get price action up there, I'll get out. And then I'll short it. So I'm using the very first version we looked at, whereas I am going, I'll get out up here, I'll add another short and hope it comes down and I'll exit. If it doesn't, I'll re-hedge it up here. So I add that hedge loss to that hedge loss. So I've got double the loss. Fine. I'm happy to take that. But what I've done is I've taken 2 trades and 2 losses, not 9 trades, 9 losses. And I'm still in the thing. Yeah, dangerous. So those are the variations. So what I'm going to do is I'm going to build out an EA to test out some of these. I have already got multiple hedge EAs that I've built. The problem is because they're development EAs and I disproved the strategies, or I found the strategies had no edge over position trading, and that's the important thing for me. If I have a strategy and the working the inside the hedge strategy, where you get the hedge which doesn't work out and it becomes a massively wide hedge and takes you weeks to get out of, I thought, yeah, that works. And it does work. It is a good strategy. But the amount of time and effort I have to put into this compared to position trading doesn't make any more money. This doesn't make any more money than position trading from my testing. And position trading is easy. You get in long, you wait for it to go down, you get in long, and you wait for it to go down, you get in long, and you basically wait for it to go up. A baby can do this. In fact, the EA can do this on full auto for you. Hedging, you have to be involved. And if you get into 5 hedges, which become wide expanded hedges, you will find your entire day sitting there going, maths, I've got to figure out what lot size I now need. Is it going to turn there? Well, I could do that, but there's news tomorrow. What if that happens? What do I do? Should I lock that in? That means I'm going to get more, and you end up just sitting here confusing the hell out of yourself. Yeah. So that isn't one that I potentially would follow, but I have already built that out. So the trouble with my EAs, my development EAs, is I will build a model, test it, figure out the pitfalls, and then I will muck about with it. And the problem is the EA that I built to test that particular working the inside of a hedge model, I then started mucking about with it, adding new features and functionalities in, and it doesn't actually do much of what it did initially because I bastardized it, if you like, into something new. So if I run it now, it won't actually do what it was originally designed to do because I basically have shotgunned the internal workings of it and tried to do it, make it do something else. I tried to improve it. I couldn't. So I just sidelined it. Yeah. Which is what I tend to do. If I can't make it work, it just goes in the bin. Yeah. It's what strategy development's all about, isn't it? Looks great. Somebody sent me this video of this hedging strategy months and months ago, and that's why I built the EA. Somebody else, one of my other guys, sent me a document. I can't remember who it was. You might even be in here. The Holy Grail hedge. Are you in here? But I built out the Holy Grail hedge EA, which is this one, which on paper, in theory, had a really good edge. Yeah, it did make money. So it does work. But what you find is, and there you go, there's a prime example. So we entered this trade in May. This one here. We entered this on the 7th of May. We got out of this on the 2nd of June. So nearly a month we were trying to work this hedge out, and it did. So that was a total of $1,000 drawdown, which is fine. It's a 50k account. We drew down by 1,000, 2% we drew down on the hedge, but it took a month to make 2%. And we couldn't do anything else until the hedge was exited. Yeah. So the downfall of this type is you can be stuck in these things. but it does work. Yeah, it's got a long-term edge, but as you can see, it can build up some substantial size. But because it's hedged, you'll always be able to get it on, but sometimes it just gets stuck. And again, I've mucked about with this, so this might be my variation on it, trying to improve it, trying to get the trade time down. But you can see that the hedge, I just have to slow that down so that I can move the window. You can see the hedge here, look, we've got, I don't know how many trades on. There's a shed load of trades on there, yeah? But the whole idea of hedging is you're locking in tiny bits of loss, which will gradually build, but it's fine. I'm only in 4% of drawdown on the account. And I have a bias long. So if it moves up substantially, this will exit with a profit. I've got to wait for this thing not to do that. This is the problem with most hedging strategies. We're trying to do something. We want the market to do something that it spends less than 30% of its life doing, breaking out and trending. That's when hedging strategies that are locked into hedges come into their own. Trending instruments, yen pairs, Swiss pairs, potentially some parts of the year. If you had a hedging breakout strategy, it will clear up, absolutely clear up. So there you go. So that's pretty good. Look at that. It says time's up. So that's pretty much my entire knowledge on hedging. There are also an awful lot of other variations on this. But they all come down to the core of finding an area to hedge and a reason to hedge, and using one of those three methodologies, which is adding a slightly larger size to give you a bias, martingaling to get out quick, or multi-directional trading and working a hedge until it's disappeared. Now, they all work sometimes. So that's my kind of plans on what to do with it, to demonstrate it further on Friday. So if you've got any questions on it, if you're watching on replay, comments or Discord, or if you've got any questions now, let me know. If you've got any variations on hedging, I'm happy to look at them. I haven't looked at everything, obviously. And hedging is one of those elements that I've been down the route many times, and I've never found an advantage over position trading methodology. And I'm not particularly a fan of breakout trading either. So it's one of those that it's never really sparked my interest to the point where I've really wanted to develop it. But I can develop a profitable hedge EA. But it's not going to help me because it's not a different style of trading to position trading, because we're just waiting for market movement. So not too interested in hedges. Good, honest answer, Linus. Yeah, I mean, it has got the beauty of it is, and the reason I developed it, and I love it for the SIH. Yeah, so I love the stock index hedge EA. You know, I say I'm not a fan of hedging. I have a strategy I trade every day, which is hedging, but it's a breakout strategy. And the reason I hedge it is because I hate breakout strategies, because breakout strategies are notoriously hard because most breakouts fail. It's usually market exhaustion. It's just, it doesn't stop at the same level. So people think it's breaking out. It's not, it's just exhaustion, and it's limit orders holding the price in place. So it takes a lot for a breakout to occur. With stock indices, the reason the ORB strategy works and SIH works on stock indices is because we have an opening bell where there is a massive volume of order hitting at one go. It's like a news event that we know is going to happen every day at the same time. Brilliant. We still can't predict the direction, but it will go somewhere most of the time. So if you can get it right, happy days. You go straight to target, you walk away. If you don't, you buy yourself the rest of the day to figure out where it's going. If it goes nowhere, you lock in one loss. That's why I love the SIH, because it's simple. ORB, I also loved, and I traded ORB. If you go back to the years ago live streams, I was trading ORB in the same way as I'm trading SIH every morning and every afternoon. But the thing I found with the ORB strategy, opening range breakout strategy, is it drives me nuts. Personally, me. Not everybody's going to get driven nuts by it. But I'm the type of person where if I'm getting constantly smashed in the face, i.e. stopped out all day long, it drives me mad. And I'm not happy to trade in that way. That's me. Younger people, I find, are much more inclined to want, yeah, let's do it. I don't care if it loses. I know where the edge is. I'm going to do it. And they're happy to be stopped out 10 times a day because they know they will make their money eventually. Me, I'm not so much like that. So each person will have a different way they like to trade. And hedging for some people is the way they make money, because it is also a less stressful variation of trading, because you are locking in a loss. You're saying, if it doesn't work out, I'll sit there with my loss for the day and I'll figure out, I'll have a cup of tea, walk the dog, I'll come back later and see if it's moved. Yeah. You're not sitting there going, I've lost 1%, I've lost 1%, I'm 2% down on the day. Your immediate reaction is, I've got to get back in because I need to get 2% back. With hedging, you haven't got to do anything. That's the advantage. It makes you much more relaxed as a trader. So there is a benefit to it, which is why I've never discounted it. But there are ways to hedge and there are ways not to hedge, in my opinion. So it's just a case of trying to find what works. So the main model I'm going to build out is the range break, where you add extra size. Yeah, not martingale, but I can also do the martingale thing. Yeah, so in the Swiss Army knife, I have martingale built in. I've expanded it, so we have martingale. So I can hedge with martingale, or I can set that to 1 and hedge without martingale, or I will also build a variation where it takes my initial lot size and adds X% to it. So we will try doubling the initial lot size and then remaining on the double, which gives us a constant edge. Or we will add a little bit, or we could have it that we take the last trade and use martingale, but instead of using martingale, we add 1.1 or 1.2 to martingale, which will constantly increase our lot size, but only by a little bit, which gives us a constant edge. But the edge grows, meaning that the TP distance doesn't have to be as far, potentially. So again, there are lots of variations to look at. You know, and this might be the time where I find one that actually looks good, makes sense, and I want to trade it. But I haven't spent an awful long time in my career looking into this, because when I discovered position trading methodologies, this kind of went out the window. Just didn't pursue it. But a lot's changed since then. There's a lot more courses come out on it. A lot more people are aware of it. So, but it is also a constant way of making money. And the advantage, I think, to hedging is intraday. So setting yourself an amount of money to make a day and trading time frames like 15 minutes or 5 minutes, where you use high risk, but you only get one trade a day. A little bit like prop. And again, a lot of prop firms won't let you do what? Hedge. Why? Because it works. Yeah. They won't let you position trade. They won't let you hedge. They won't let you use martingale. Why? Because they all will generate money. They don't want you to do that, because if you do that, you don't buy valuations. And, you know, we've been around the prop circle a while. Yeah, that's how it works. So, okay. So yeah, any questions? Any other questions on it? Is anybody still here? Again, I still have no idea who's in here. I need some way of figuring out who's in here. I'm relying on everybody saying stuff. Excuse me. No questions? Interesting. Yes, Steve's here. FTNet's here. Good. So yeah, so that's really it for hedging. Linus is here. Good. No questions. Okay. So yeah, so that's the theory. So I will build out the EA. Bill's still here. Linus is going now. Bored. Don't want to do hedging. So yeah, I will build out the EA. and I will basically use the EA to demonstrate the advantages and disadvantages of it in, back testing, so we can see stuff playing out over time. As long as you know what the pitfalls are and you fully understand how a strategy works, you can use it. Yeah. It's these ones where virtually all the ones you see on the marketplace and stuff, they all use martingale, and martingale is death. I've actually done here we go. I'll show you martingale in action. Let me just reset this. True, 0.1 and 2. Yeah, we're going to use we'll use the current time frame 20 MA for direction. Yeah, so I'm just going to run this. This is running martingale. This is pure martingale based on direction of moving average. Yeah, so oh, hang on, I've got hedging set on. Oh, I've changed the EA. I've changed something that's broken this now. Oh yeah. Okay. I need to put. I can't use this now because I've put the hedge strategy, and I have forgotten to turn off the auto hedging on certain things. I can't use this. I can't show you. But I have built EA built hedging martingale into the EA now to demonstrate martingale, and I have found a martingale strategy on the hourly time frame on the pound US dollar that doubles an account in 4 years. At one point it takes 40% drawdown, and it looks great, but it takes 40% drawdown at one point. And you know what it was? It was 2 trades away from blowing the account. If that one trade that took the 40% drawdown, yeah, had not have won, the next one would have lost. If the next one would have lost, if I'd have managed to get the leverage on, that would have blown the account. So it's always 1 or 2 trades away from an explosion. But the equity curve is gorgeous. I'll fix the EA because I'll be able to show you that tomorrow. I know what I've done. But yeah, it's interesting anyway. Martingale. It's why everybody gets sucked into it. There's probably nobody in here that has not tried a martingale strategy. We've all done it. Everybody gets sucked into it because as soon as you start trading, you want to eliminate loss. Martingale eliminates loss. You suddenly go, this is the best thing since sliced bread. And then you suddenly blow up. And if you haven't discovered martingale yet, now you know. Good, well done. You managed to not blow an account. When I hedge, I try not to close the hedge. I keep it as security. I use martingale, but I also use equity protector. Yeah. Well, so yeah, so Steve, if you've got a hedging strategy that works, let me have all the details, and I'll build a model out on it. There's other ways you can do hedging as well. I mean, I haven't covered it in here, but there's also the partial close hedge strategy. So you can have hedging where whatever the hedge is, however the reason the hedge is taken, when you take a profit on the direction that works, you use a percentage of that profit to reduce the other side of the hedge. Yeah. So if this was a 0.1 and we've got a 0.2, for example, we got a 0.2 there. So we would reduce that down to a 0.05 using the profit taken here. Yeah. So we bank a little bit and we minimize the risk down here, which is fine. However, when you get out here, the distance here means that the actual drawdown on the other side is actually quite big. So you find you quite often can't shut half of it out. So that ends up shutting out a third of it, for example. Then if the price does that, this exponentially gets larger and it becomes this never-ending snowball, like I say, where you suddenly get this trade that gets left down there and you're like, how the hell am I going to get out of that? I need price to reduce the drawdown so that I can get rid of a bit. And if you don't get the timing on that short right, you won't get that off. And this is where those expanding hedges come in. And all the theories they teach you on YouTube and in courses and stuff show you the perfect example. Okay, now we close that one, we reduce 0.2, and then it comes down. We then take that short off, we reduce 0.2, it goes up, we re-hedge, it comes up to here, we take some profit, it comes down, we reduce that to 0.1, and and now we're out. And they show you the perfect market condition for that scenario. That don't happen very often. What happens most of the time is it just goes parabolic. The pound inflation number comes out lower than expected. Bye pound for 3 weeks. Oh, I'm long. Good luck getting that out in the next 6 months. Yeah, that's real life. Yeah, and this is what my testing showed. Yes, it will work, and yes, you can. Because you're locking it in, you're never going to blow your account. You're always going to be hedged. But it's the time. That's the problem with hedging, the time. It's hard, but that's why I don't close. I keep the hedge. Yeah, but you've got to be able to get out of the hedge at some point. If you've got a hedge that you keep, and the market goes the other way for 6 months, what do you do with that hedge? You've got to have a rule set to get rid of it, haven't you? So, but yeah, I'll be interested in what your variation is that you've looked at, Steve, because I'm always up for looking at different variations on things, because people have ways. There's a million ways to do everything in this industry. There's nothing that is set in stone and this is the way that it has to be done. If that was the case, everybody would do the same thing. And if that was the case, nothing would work, because if everybody's doing the same thing, there's no one to disagree with you. Therefore, trading doesn't exist, the marketplace doesn't exist, and trading is gone. Difference of opinion is why the market moves. Remember why a market moves. Because we've got one person buying, one person selling. For the order to take place, either he has to come down in price or he has to go up in price. Otherwise, stalemate. Yeah, you've got to have disagreement. You've got to have different variations on doing the same thing. Some are better than others. You know, like I said, I haven't found everything. There's a billion strategies out there. There's no way I'm testing everything before I die. So if you've got something better, I'm, you know, always love trying new strategies and trying to make them work. US dollar CAD hopefully wicks off the hourly propulsion. Is that moving again? So that hopefully is holding. If not, here. But like I say, there's a, you know, look at market reversal and market structure. For an M pattern to form, you need a second leg. Yeah. So a market structure reversal is an ending, and usually something like that. Yeah. So at the moment, we've just got leg one. Leg two is forming. So that's why I said this morning in the live room, I wouldn't be surprised to see us up here today, ahead of tomorrow, hopefully. We'll see. We will see. US dollar CAD, yeah. And some brokers won't let you withdraw with open trades. No, it depends on your broker, I guess. Yeah, maybe. I don't have a problem. Basically, as long as you're drawing down and you're not taking yourself into a margin call when you withdraw, you're fine. But yeah, I mean, some brokers don't let you out, I guess, if you've got open trades on. It's just another control mechanism to keep you in the trade, because they know that there's a 70% chance the trade's going to fail. So, or whatever the percentage they come up with. So yeah, makes sense, doesn't it? No problem. You can either close all that out in a loss, or I want you to go flat. So you're probably going to lose a bit more money, which means you can't draw out the money because you just lost it, which means you're going to stay there and they're going to give them more of your money. Brokers are not your friend. At the end of the day, their job is to take all of your money in one way, shape, or form. They are providing a platform for you to supply the money to them, or to the market in general. It's all good fun, isn't it? Who said this was a really good, fun, interesting job that made a load of money, eh? I was told this was easy when I started doing this. Some bloke called Greg Secker said, he could teach me everything. I never did Greg's course, by the way. I came very close to doing it, but never did. I went to one of his seminars. You know, they do these daily seminars. So you go along for a day and it's totally free. We'll teach you to trade for free. It's a day. Come along. Doesn't cost anything. We'll teach you how to trade. It's a massive sales pitch. Hey, everybody, this is what we have. This is what we do. And these are the sums of money we make. This is Greg Secker. He's a multimillionaire, not through trading, but he's a multimillionaire. We'll make you think he's a multimillionaire through trading. And this is the sort of thing you can have. Do you like it? Yeah, this looks good. £2,500, please. Oh, I thought it was free. Yeah, this day was free, yes. But if you want to learn how to trade, £2,500, please. Oh, and now you've learned to trade, I want some money for the software monthly, please, to provide the signals, which will fail 50% of the time, please. Never-ending money-making machine. Brilliant, isn't it? I wish I was Greg Secker. I'm not. I couldn't wear eye makeup, so it's definitely not me. Right, that's all today then. So I will go off and work on that EA. It's always good. I want to rebuild it properly as well. Anyway, just because it's nice. It's a nice to have, and it is a strategy that can work. So it is a strategy I think that some people might be interested in. So I might put the EA out there for people to buy as well, if I can get one that actually I think is worth having. So kind of something I want to develop a little bit further, really. And it's not actually a bad thing to have a hedging strategy running on an account, because it also gives you diversification. If you've got position trading squeezes going on, hedging strategies are probably going to do pretty well during squeezes, because they rely on market movement and breakouts. And basically all a trend is, if you think about it, is it's a series of accumulation breaks. Yeah, a trend is just nothing but accumulation breaks. Breakouts. Yeah, if you're hedging, you've got 1, 2, 3, 4, 5, 6, 7, 8, 9 successful hedges there in the last 2 weeks. Nothing wrong with that, is there? If I'm in a squeeze short, why not let the hedges make you money on the way up? So it's not a bad thing to have, but got to be done the right way. Right, so that's it for today. Anything you need, let me know. I will be in Discord, and obviously if you're watching on replay, comment section if you've got any questions. Some people are having trouble getting into the Discord members for some reason. There's something to do with account linking and different types of accounts or shared accounts and stuff. I can't do anything about that, unfortunately. So you can communicate obviously via normal Discord directly to me, or use the comment section. But yeah, hopefully whoever's having problems with that will get that sorted anyway. So, all right. So have a good day. I will be back tomorrow. Tomorrow we're going to cover correlation and exposure. So the importance of currency correlation, understanding currency correlation, why currency correlation happens, and how it affects your exposure, positive, negative correlation, all that sort of stuff. So it's an important session, especially for those using automation, to understand how you shouldn't be using every single pair all the time necessarily because of exposure. So we'll go through that in a bit more detail, and correlation and that type of stuff. All right. So I'll see you guys tomorrow if you can make it. Otherwise, hopefully in the 8 o'clock session. And if you've got any questions, let me know. All right. Have a good day, and I'll see you next time.